Welcome to another edition of Around the Table with Stacy Smith. Normally in late January, we get the January thaw, but that is not the case this year. And as the temperature has plummeted in the month of January, so have the different stock markets. Unless there is a very dramatic turnaround today, we might just be having one. The Dow, the S&P, and the S&P 500 and the NASDAQ are all going to register a loss for the month. In fact, as of the close on Friday, with just one trading day left to go in the month of January, the NASDAQ is on course to post a huge loss. By my calculations, it will exceed the percentage loss in January of 2008. Now, the losses for the Dow and the S&P and 500 are not as dramatic. But why did the markets drop? Is the decline over? And how should you, as an investor, react to all of this? Well, that's one of the questions I'm going to pose to our group of panelists here today. I'm going to reintroduce them to you. I would like you to meet Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. As we go around the table, we find Frank Rossetti. Frank has been advising clients for 50 years. Frank helped to establish Harvest Financial, where he is the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and founder of Boca Capital Partners. Kim has a dual background in both finance and software engineering. And you may have seen her on her many appearances on CNBC, Fox Business Channel, and also on Bloomberg. And the last panelist at the table is a name very familiar to a lot of Pittsburghers, Bob Fragasso. Bob has been in the investment advisory business for nearly 50 years. He is also the chairman and the chief executive officer of Fragasso Financial Advisors. Once again, thank you for all of you for joining us for Around the Table. Before we hear from you, there's another statistic or two I'd like to throw your way. While the drop over the past several weeks in the stock markets means the markets will lose ground for the month, it is something that does seem to happen in January. Since 2000, the Dow has registered a loss for the month of January 61% of the time. The S&P 500 has posted a loss for the month of January 56% of the time. And the NASDAQ, it loses ground in January 47% of the time. So with that in perspective, that January is not necessarily a great month anyway for the stock markets, I come back to this original question. Why? Why did the markets retreat this month? So Frank Rossetti, I'm going to start with you. In the past several programs, we have discussed a possible rise of interest rates. Is that the reason, or is this just time for the markets to pull back some?
Well, everyone wants to pin one reason for the market's move anytime. There's rarely one reason unless it's a surprise. There was nothing surprising about the rise of interest rates. That's been expected for quite some time. So although that's a reason, you also can say part of the shrinking of the Fed's balance sheet is part of the reason. You could say that the turmoil between Russia and Ukraine and our involvement in that is part of the reason. You could even go so far as to say China versus Taiwan is part of the reason. There's, I'm sure, many other reasons we can talk about, like the Omicron virus and its permeations, which I understand there's another one. So there's many reasons, not just one.
All right, great. Let's go to Kim.
So I think investors are very much like herd animals. It only takes one or two things for them to begin moving in a certain direction, and off they go. And that's what I'm going to say happened this January. Yeah, everybody's climbing the wall of worry with Omicron, inflation, maybe a little war with Russia. I don't know. But I think investors generally took a look at their portfolios and kicked out some of the more risky aspects. But, investors like to move together. So let's see what happens next.
Bob, your take.
Agreeing with my colleagues, as I always do. I would have to center on the fact being primarily interest rates. And Frank is right. It wasn't a surprise. But when Federal Reserve Chair Powell said that we may have 4 interest rate rises this year, that hit the market and that started a bit of a spiral. And I would like to point out, however, that fear is overblown because the 4 rises at a quarter point each will only get us back into normal interest rate parameters.
Okay, Carrie.
Well, stocks were priced for perfection going into 2022. And with the prospects of higher interest rates and the prospects that growth may actually be slowing, it's really no surprise to see that high valuation stocks have come down significantly. And we've had a little pressure on those more value-oriented stocks that generally provide more stability.
I'm going to throw this out and anybody can and take them. Is it a combination of all of these things coming at one time? Because you don't necessarily have all of these at one time. Is that what made it such a dramatic drop, especially for the NASDAQ?
I would say, because people are feeling negative anyhow. And in the litany that Frank and we gave, throw in the political malaise and the battles that leaves not just the fact of its existence, but leaves tax planning and estate planning and other monetary planning uncertain.
And just to add to that, this really, I know it feels like a dramatic decline for 1 month, but when you go back and you look at market history, we generally have at least 1 or 2 months where we have a significant decline in the market. So honestly, this really isn't anything so abnormal. I think we were spoiled last year. We had a fairly smooth ride, but even last year we had some negative months. So investors should not be panicked.
I'll postscript that with a natural letdown after the holidays. There's a gulf between the holiday spending and then the earnings season. And that's usually a letdown period, as your initial batch of statistics pointed out, Stacy.
I also think there's a little changing of the guard from the stocks that worked well in COVID to ones that don't, that a more growth-oriented economy will benefit from. So I'm thinking of Netflix and Peloton. Those were, the poster children for stay-at-home sort of activities, and neither have done well in this latest reporting period. So a little changing of the guard helped spook that market too.
Also, you can note that the stocks that seem to have gone down less versus those that have gone down more generally are revolving around the businesses that they are in. Our mantra around here has been we tend to invest in things that actually make money. Many of these stocks that drop don't, nor have they, and they don't project to make money sometimes for years, which those aren't businesses that I would invest in particularly.
Yeah, I remember that we go back to the tech bubble bust back around 2000 or so. Many of those companies that were highly valued, none of them had posted a profit at any time. And finally, it's like the rug was finally pulled out from underneath them. But that's something I would want to kind of get into in a way. Kim, this decline has been centered a lot on the NASDAQ. As opposed to the Dow. As of Friday, the NASDAQ was down more than 12% for the month. That is the largest decline for the month of January in the past 23 years that I've gone back to take a look at statistics. So do you still like tech-oriented stocks?
I always like tech-oriented stocks, but, and I guess I am piling on here with Frank, I like ones that have reasonable balance sheets, have an identifiable business, which we'll get to in a second, and make money. So I am more, and I have always concentrated on this area my entire life as a stock picker, is that the companies that provide productivity to other companies. That I think is key. So that rules out any of the kind of consumer-oriented or extremely experimental companies that are in NASDAQ generally. So do I like NASDAQ? Maybe, maybe not. I like a lot of the stocks that provide productivity to other companies. That's what I like.
That being said, adding to productivity is particularly critical right now because we have a labor force that is far from growing. And we're going to have to replace the people that used to do work with the machines that can do it today.
And as with any, I'm sorry, Carrie, go ahead.
For investors that are following asset allocation, now is a great time to be looking to rebalance your portfolio. And what those models are suggesting is that investors are adding to growth because the price has come down. We have to remember that old saying, buy low, sell high. And there are some great companies out there that are on sale right now that rarely go on sale.
To piggyback on that, and my comment was going to be that any word has to be broken apart. It cannot encompass an entire genre. So tech stocks have to be seen in tiers. The largest, most well-capitalized companies, as we discussed in the last show, are going to be fine. It's the ones that are banking on the future, an idea, and they don't have earnings. And you've got to break those apart. And as I'll say, along with Kim's comment, we never buy stocks for our clients that do not have earnings. The pioneers attract arrows, the settlers get to harvest the crops.
Okay, well, that was the question you brought up. I was just going to ask, is that the same for almost all of you, that you don't buy companies that don't have earnings yet?
Pretty much.
Yeah, and what we're really looking at is we're looking for those companies that have earnings, but also have high growth rates. You know, for investors that can withstand more volatility, we may be investing in companies that have a higher valuation as it relates to the price earnings ratio that we've talked about before, but also have high growth rates. So that's where, when we move up the risk curve, that's where we tend to go.
I think I'm accurate when I say that all of our clients, for all four of us, are people who are serious about their money. We don't tend to attract clients who are taking the long shot and hoping to shoot for the moon and they're willing to lose it all. That's not where our people are coming from.
Well, maybe not shooting for the moon, but let me ask this. I mean, so many times you hear people say, well, you know, I got in on Apple when it was just starting, or Amazon, which was, you know, had an up period, a down period, and then it took off once again. When do you know to invest in those? Do you absolutely wait for some sort of earnings report? Because you could get in and see, you know, ride one very high.
When there are proof points, not just on an idea, not just on a glib description, but when there are proof points, and earnings would be the primary proof point, then you can make an informed decision. And it should be part of your overall portfolio. Don't bet it all on the news.
Yeah. And as Bob's talking about overall portfolio, you know, one of the important aspects that goes into asset allocation is really position sizing. So for those companies that we may have a good runway for and see earnings and hitting those proof points, we may be adding a much smaller allocation to those companies, knowing that they have added volatility.
And in your question, Stacy, you're assuming that the investor who got in very early has a cast iron stomach and can weather all of the horrendous dips and the hair-raising movements up. You don't have to remember that far back when Apple went in the bucket. Would you have stayed with it throughout had you been an early investor? So it's great when you look back, but it's not that easy when you're looking forward.
I mean, you could
I
look
also think that, oh, go ahead.
No, please.
I also think that having some insight into the industry or company itself might be able to give you a leg up on not only their groundbreaking technology, but the management and whether or not they really do have a line on additional capital to be able to fund their growth. And I think that it takes a very, very special investor to have all those components, as well as the cast iron stomach, to be able to live through somebody that claims whenever they go public and are not making money that they're going to change the world. And I think you need to beware. But if you have that insight into all of those aspects of the company, maybe you do, you know, put something towards that company, but not a whole lot.
Frank, you were going to say something.
I was going to, just to add to what Kim's saying and to what Bob was saying earlier, you have to be able to live through some pretty gut-wrenching things. I mean, just take, for example, not as a recommendation, but as an example, Moderna, the drug company, the one trick pony, if you will, that has the Moderna vaccine and the technology that is purported to be able to change the world going forward. Here's a company that actually makes money. It's trading at a low multiple, and yet, just give me a second here, it was as high as 497 this year, and today it's at 165. And yet it makes money. that is a gut-wrenching move, because this is a new company that's coming out of the R&D phase partially, and it still has a lot of questions about whether or not the management can take it to the next level.
And how many investors would have stayed for that downturn? Everybody's brave in a bull market. When you get that kind of a drop
Yeah.
by 50, 60%, you're not that brave. You bail
Bob,
out at the wrong time.
Bob, I'm going to stay with you here for a second. I do have all these stats I've been throwing out, a little bit of research that I try to do. There is some encouraging news regarding losses in January. Over the past 23 years, a loss in January has led to a loss for the year, only 7 times for the Dow, 6 times for the S&P 500, and for the NASDAQ as well, 6 times. So when we're going through one of these things, you guys have kind of talked about this, but let's do it again a little bit more. How does one position oneself in this kind of a market?
I don't think you can say this too many times, because people lose track of it. Not because they're not able to conceive it, but it's because the fear-greed thing of emotions overcome the judgment. And that harkens back to what I said about the post-holiday lull. Even in a placid year, there's usually a downturn, which again, your statistics point out. But then there's a recovery as we get into earnings seasons. Positioning in all markets has to be, and I know I'm putting people to sleep when I say this, but it has to be a balanced asset allocated portfolio, so that the hills and the valleys are not so pronounced and you will bail out. You will get the kind of return, nothing's guaranteed, but historically supported, that you should have if you're asset allocated properly. There's no viable alternative of jumping in and out of the market and timing markets. It doesn't work. It's a prescription for disaster. So boring as it sounds, construct it as solid, your portfolio as solidly as you would construct your home. So when the winds come, like we had and like the Northeast had, it's not going to blow over. Your portfolio will weather through, and you'll have the courage of your convictions. For example, when you look at the stocks and the bonds that populate your portfolio, you've got the right asset allocation model. Now, are you populating it with the strongest candidates in each of those asset sectors? If you're not, why are you holding it? That's where you make the change. That's where you can make a beneficial impact in your portfolio, not trying to time markets. So have the strongest, for example, large cap mutual fund in your large cap growth sector. That's only one example. If you don't have the strongest, then get the strongest. Same thing with individual stocks and bonds.
So let's move on to Kimberly. Kimberly, your thoughts on this?
So I agree that you really have to know what's in your portfolio. You have to have companies that are not, let me repeat this, that are not gambling, right? We are putting together, or you should be putting together, a portfolio of companies that you're the owner of and they work for you, as opposed to buying lottery tickets, thinking of it that way. And probably the biggest thing is expand your timeline. Don't freak out over the short term. If there's anything that I see people doing wrong, it's that they think when the market's going down that it's going to go down till it hits 0. I think they're going to be wrong on that. Most of it
never happened in history.
Right.
No, it never has.
And is
Frank.
my microphone working again?
Yeah.
We'll get
You seem to be better. Go ahead with what goes in January.
Yes. There's a saying that as January goes, so goes the year. And as you pointed out, that is absolutely not true. In fact, if we go all the way back to 1980, only 33% of the time have negative Januaries resulted in a negative year. So when we have added volatility like this, what's really important to understand is the risk. There is a difference between volatility, ups and downs, and permanent loss of capital. So as investors are looking at their portfolio, they're going to want to assess their risk and their risk tolerance, because we may have added volatility this year, as we have seen in January.
Frank, you want to wrap it up?
Sure. What Carrie's talking about is risk versus risky. With risk, it goes up and down. With risk, it can go away, which is not at all the business we are in.
Okay. Good. Carrie, I'm going to stay with you for a second here. Some of the economic, and we've sort of touched on this earlier, but I'd like to go back into it a little bit. Some of the economic signals have not been encouraging recently. Consumers spent less in December. Inflation is anything but transitory, up nearly 6% compared to last year. Personal income compared to inflation has dropped 5 straight months. So have we, with the market reacting to a lot of this, have we set the low, or what kind of a year might this be? What should investors be looking at? I'm not asking you to try to put it, your crystal ball out there and say that, yes, the low was set at exactly at 205 on, January the 24th or something. But what do you think?
Well, the first thing is investors should not panic. And one point that I want to make, and this is very important, is that people are panicking over the possibility of the Fed raising interest rates. And I think someone may have even said earlier that they're raising them 4 times. Not only did I listen to the chairman's speech last week, I read the transcript. He at no point ever said he was even raising interest rates once. So he has said that he's positioned to raise rates if the data supports that. So I turn off the speech, I look to CNBC, and they're saying that the Fed's raising rates 5 times. And that's just not true. If anything, we may see a Fed, and the Minneapolis Fed chair said this over the weekend, that we may get a hike. It's possible that we'll get a hike in March and then a pause, because the other data that's coming in is an economy that may be slowing. And if we have an economy that's slowing, I can pretty much assess that what Jerome Powell is thinking is that we're not going to be having 5 interest rate increases. It could be one and done if growth slows. So we have to continue to now watch the growth side of the fence. And for investors, what that means is to make sure you're properly allocated. And that means owning bonds. And we've already seen a reaction to the long end of the yield curve, meaning that interest rates that are longer in maturity have started to come down. So we're looking more at the possibility of a soft landing rather than, all kinds of interest rate hikes.
I'm going to comment that Powell, you're right, Carrie, he did not specifically say how many interest rates or that there would be. But if in the context of his words indicated there could be the need to make multiple adjustments over time, and the market immediately reacted to it. And as a proof statement, I'll say that Alan Greenspan's wife said, the former Fed chair, that he asked her to marry him several times before she understood what he was saying. So you've really got to listen closely to what a Fed chair says, but it did react. But I will say that higher cost of living right now is causing people to buy less because they're spending more for essentials. But as inflation, which is COVID driven, supply chain driven, calms down, we will get to a more normal level of inflation and spending will get back to normal. And hopefully the Fed won't have to raise interest rates multiple times because inflation will tamp down.
I'm going to say something really controversial. I don't know that the Fed caused the inflation that we see when we put in our gas tanks, put stuff on our back, and put stuff in our mouth. That was caused by COVID, supply chains, and fiscal spending from the government. Now that is slowing, and I believe people are just not going to buy really expensive things, like they'll slow down driving, right? That always happens. If you have $4 gasoline, which I'm not forecasting, but I'm just using a big number, right? People say, I'm not going to take that trip. I'm not going to buy that extra shirt, and I'll let those grapes sit there until they go on sale, right? Like, that's what people do. So I think Jerome Powell knows this, and he is, as Carrie pointed out, being very careful about what he says. He's not guaranteeing that he's raising any kind of rates, but I think he fundamentally knows that those rate increases aren't actually going to turn around the inflation that we experience. Now, I will say asset inflation, and that's in buildings and stocks, that is driven by the Fed, but we don't actually feel it until we go buy that house, right? So I don't think the Fed is in this huge hurry to try to affect the price of milk and eggs.
To follow on to what Kim's saying, it's very likely that as they reduce buying bonds and mortgage-backed securities, you're going to see the shortage of housing shrink, and you're going to see asset prices slow down and relate more to actual earnings than the mere fact that there's more money than there is securities. And the supply-demand equation should get back in line and cause things to behave maybe as they should.
It's interesting. Almost all of you believe that we're probably not going to see these 4, maybe even 5 rate increases as some people are projecting. What about the possibility, and we'll do this very quickly if we can, what about the possibility that you'll get a bigger hit if indeed he raises rates, or the Fed raises rates, it's not entirely up to him, in March, of instead of a 0.25%, he might go half?
I think it's already discounted. Go ahead.
I think it's unlikely that he'll do that if we have economic data that is showing that growth is slowing, and we're already starting to see that. He has been very careful in his comments to discuss the data and watching the data. And the thing that will cause a recession, and he knows this, is if you raise interest rates going into an economic slowdown, that creates a hard landing and not a soft landing. So for investors, the market's kind of reacting to, as Bob just said, these rate increases being priced in. If you were to do 50 basis points, it's being priced in. And the big question is there an overreaction in the market, which presents a buying opportunity for investors? But having said that, everyone has to consider their own asset allocation and their own risk tolerance.
In the history of interest rate rises, as Carrie said, at the top end is 50 basis points, 0.5%. Oftentimes, and usually, it's 1/4%. And that's already been priced into the market. That's why we got the reaction we did.
All right, Bob, I'm going to let you have the final word on that, because and I want to thank all of you for all of your contributions on these particular subjects. I thought it was a good discussion today. But now it is time for us to check in with Kim and find out about her latest stock suggestion. Now, before we hear from Kim, I want to stress that under rules and regulations of the SEC, that Carrie, Frank, and Bob are not allowed to state publicly any stock picks, and that anything that Kim touts is her suggestion and only hers. So, having said that, Kim, you've made 7 picks so far. Here is where things stand as far as I've been able to calculate them. Xilinx is up 14%. VF is down 15%. J&J is up 7%. Morgan Stanley is up 2%. Micron is down 3%. AT&T is down less than 1%. Your last pick, Coca-Cola, is down less than 1%. That puts your overall portfolio on around the table, showing an increase of 3.5%. So, which stock do you pick this week?
Sure. And again, you have to look at your own risk tolerance and do your own homework on whatever I say. Don't take my word. Figure it out yourself. But what we're looking at is a company called Elanco. The ticker symbol is ELAN, and it is a spin out of animal-focused pharmaceuticals. About half the revenue comes from house pets and those kind of animals, and the rest comes from agriculture. Cows, chickens, pigs, things that we eat or, that help us do things. So I like the split between agriculture and pets, because you're not overly dependent on one or the other. And the company has more than adequate management that should be able to guide them. I think the biggest negative that they've been experiencing is they've bought some products off of Bayer as part of Bayer's spin out and repositioning of their product line of chemicals. And I also think that this company is new to the public markets, and their management really does have to understand the tempo and how to talk to investors, especially investors like the people you hear on this broadcast. So professional investors need to hear information a certain way. And it's often difficult for even the most seasoned managers who have not been in that white hot spotlight of talking to investors to know how to set expectations correctly. So this is one of those companies that probably a little early on because it's a relatively new spin out from Eli Lilly, but I like Elanco. And I also like my pets and your pets too, probably. And this helps animals live better lives. So Elanco.
Elanco. All right. Kim, thank you for your suggestion as a stock pick this week. I want to thank all of you once again for joining us, and thank you for joining me. And I hope that you are joining us again the next week for the next edition of Around the Table with Stacy Smith. Thanks again. We'll see you then.